Double entry system for recording revenue and expenses. So what is revenue? Revenue is the money received or will be received in the future by the business arising from goods sold and services rendered in connection with its day-to-day activities. Some examples of revenues include, so that's revenue from sale, the money you get from sales, service fees received, rent received, commission received, interest received, discounts received. So those are few examples of revenues. Revenues increase capital. So revenues, they increase capital. And remember, as capital increases, we credit. But the thing is, the credit entry is not made in the capital account because we don't want to overcrowd the capital account. So all these entries affecting revenue, they are made in their respective revenues account. So let's say, for example, rent received, that's the account being affected. We won't put this entry in the capital account. We will put it in its own respective account. So we would have the T account labeled rent received account because we don't want to overcrowd the capital account. So as it pertains to expenses, expenses are money or other assets that a business uses up as a result of its activities. Examples of expenses include insurance, stationery, wages, salary, carriage inward, carriage outward, rent paid, interest paid, and electricity. So these are some examples of business expenses. And what expenses does, it reduces capital. And remember, as capital decreases, we have to make a debit entry. But the thing is, the debit entry is not recorded in the capital account. It is recorded in their own expense account. So let's say, for example, the expense affected was wage. You would have wage account, and you have to make a debit entry in the expense account, in the wage account, to show that capital is being reduced as a result of this expense. Then we have the joins. That's another important term that would come out in the double entry for recording revenue and expenses. So join is what the owner takes out for his or her personal use. And what join does, it also reduces capital. So the same effect that would take place as it pertains to expenses, the same would be for joins, because joins and expenses, they both reduce capital. So these two accounts would have to be debited to show a reduction in capital. So we're going to look at a few transactions so that you can have a better understanding of how to record revenue, expenses, and also joins using the double entry system. The first transaction reads, on April 7, 2019, received rent $3,000 in cash. So it can be a case where there is an empty room on the building or on the business that the owner isn't using up, and as such the owner decides to rent this building. So that's a stream of income right there. So now we are going to identify the two accounts that are being affected in this transaction. So that would be rent received and cash. Rent received and cash are the two accounts affected in the first transaction. Rent received is a revenue account. How do we know that? Revenue is the money received or will be received in the future. So right here, the business would have received money for rent. So that's a revenue. That's a stream of income right there for the business. Remember, as was established earlier, revenue increases capital. But this entry is not made in the capital account because you don't want to overcrowd it. So for one of the T account, we're going to have rent received account, and the other one we're going to have cash account. So rent received, it's a revenue account, and remember, revenue increases capital, and as capital increases, we make a credit entry. So we're going to credit that revenue account. Right there, we would have recorded how the rent received account should be treated. So it should be credited to show an increase in capital. Receive rent $3,000 in cash. So if the business received $3,000 in cash for rent, what is happening to the cash in the business? It is also increasing. Cash is an asset, and as an asset increases, we are to debit. Here we have it. This is how the cash account should be treated. So cash is increasing, so we have a little plus sign right there. Cash is an asset. As asset increases, we debit. So now we're going to reflect this transaction in the T account. So rent received is a revenue account, and revenue increases capital, and as capital increases, we are to make a credit entry. So revenues account, they are always credited to show an increase in capital. So we come to the credit side of this revenue account. So we come to the credit side of rent received account, and we're going to make that entry. So remember, we put the date first. Then in the details section, we would have the name of the other account in the transaction that is either increasing or decreasing. And then we put the amount. So we're going to reflect this in the T accounts. So there we have it. The rent received account is credited with cash to show that cash was received in the business for rent. So now we're going to go to the cash account, and we are to make a debit entry in the cash account to show that cash is increasing in the business as a result of the rent that was received. So we're going to put the date, the same date, April 7, 2019. In the detail, we would have rent received and the amount. So transaction number 1 is now completed. Remember, when using the double entry system, one account has to be debited and the other has to be credited. So moving right along into transaction number 2. On April 9, 2019, paid for advertising $6,000 by check. So the two accounts being affected would be advertising and check. Is advertising a revenue or an expense though? It's not a revenue because it's not money being received. It is an expense because money has to be taken out in order to advertise for the business. So advertising is an expense account, and then the other account affected would be check, which represents bank. Advertising is an expense, and expenses reduces or decreases capital. And remember, as capital decreases, we are to make a debit entry. So the expense account is always debited to show a reduction in capital. So now we're going to reflect this transaction in the T account. So there we have it, the two T accounts, one being advertising and the other being bank. So we are to come to this expense account, and we're going to make a debit entry. So the date, the detail will be the name of the other account in the same transaction that is being affected, and the amount. This entry signifies that money was taken from the business bank account for the purpose of advertising. And under the bank account, it was credited to show that money was taken. So the money in the bank is decreasing as a result of advertising. In the final transaction, on April 10, the owner, C. Little, took $8,000 cash out of the business for private use. remember we would have established earlier that anything taken out of the business by its owner for personal use is termed joins. So the joins account would be affected as well as cash. So joins decreases capital, and once capital decrease, we have to make a debit entry. Joins decreases capital, and once capital decreases, we have to make a debit entry. If C little, the owner, took cash out of the business, this simply means that cash is also going down. So cash is also decreasing. And cash is an asset, and as asset decreases, we have to make a credit entry. So let's show that. So there we have it. So this is saying how this transaction should be treated. So we're going to make a debit entry in the joins account, and we're going to make a credit entry in the cash account. Considering that we have already joined up an account for cash, we do not need to go ahead and draw up another one with the same name. So what we need to do, we need to come under the same cash account and just make the entry. So we only need to draw up one key account, and that would be for joins. The cash account would now appear like this. On April 10, that's for the final transaction, the cash account is credited to show that money was taken out. So the cash account is going down as a result of joins, as a result of the owner taking out money for his or her personal use. Now I'm going to go ahead and make the entry in the joins account. So I should go ahead and debit the joins account to show a reduction in capital, to show that the owner took money out of the business for his personal use. So that's a reduction in capital. The joins account would appear like this. In closing, recording transactions according to the type of expense and revenue enable the business to know the amount of a particular expense incurred and revenue earned. For this revenue account would make the business aware that money is being received in the business as a result of rent. And this expense account right here would make the business aware that advertising costs the business $6,000. So it makes the business aware of exactly how much an expense, a particular expense, costs the business and how much is being generated through a particular revenue. Thank you so much for watching. If you have any question, please leave it in the comment section below.